even able to overcome the YouTube curse.
So good. 12:30 comes around.
Did you hear about like the Drake curse of like when he bet like $1.5 million in Argentina? Like whenever he makes like a huge bet, like it always fails.
Really?
Yeah. Shows whatever. Hey buddy, ready to go?
Let's do it.
Up here. Have a screen in front of me now. Chat, chat, chat. Okay. Yeah, chat.
Sweet.
Your name. Taking a long time to start today.
You know what? Good
What?
things come to
What?
those.
We're live to what?
Good things come to those who wait.
Yeah.
Except if you're late for the Not Your Average Investor Show community, then things get restless.
Welcome, everybody, to the weekly edition of the Not Your Average Investor Show. Today, we're reviewing some notable headlines. One of them being Berkshire Hathaway, your boy, Warren Buffett,
My boy.
Warren Buffett's team, because he's no longer there anymore, I don't think. Has made a huge bet into the housing market. Over $8 billion bet that they made a couple of weeks ago, and they just doubled down in the last 48 hours. Fannie Mae is predicting some numbers that may be or may not be correlated with this. We're going to talk about it. Have we hit the bottom of the real estate cycle right now? I'm your host, Pablo Gonzalez. With me, as always, a man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flow, is a great co-host, and because his name is Greg Cohen. Say hello, GC.
Hello, everybody. Fantastic to be with you today.
And I love being in the studio with you, bro.
I know, man. I miss it when you're not here.
It's so much better when we're here and there's like a technology apocalypse every time before the show.
We can solve it together.
We can solve it together.
But don't touch these mics because it might happen up again.
Anything you touch here may break it. That being said, GC, before we get started here, we have a little bit of a tradition that we normally start, whether I'm here or not. Do you remember what that's called?
Ye old roll call.
The Maven from the mountains of Denver leading us off today. We got the Ringmaster checking in.
Drew Barnhill.
We got the KOB, the King of the Beach.
Christopher Lee
from Fernandina Beach. We got Saran with a plan.
Saran, nice to see you.
Who else? We got Belinda B from Dallas,
There we
Texas.
go. My buddy Belinda.
Good to have you. Your buddy Belinda. I got to remember that. We got our leadoff hitter batting sixth today.
John Henning.
Mr. John Henning. We got Laura Colby, beautiful investor from Washington State.
Right, Laura. Nice to see you.
Your friend, Laura, right?
Of course.
We got
Billy Green.
Good morning from the scorching mountains of Colorado. We got our friend Linda Mercurio from South Carolina.
Hey, Linda.
Linda made it on today. I love to see Linda. We got Il Maestro in the house.
John Williams.
From Long Island, New York, world famous composer. Who else we got in here? We've got Linda Evans.
All right.
Villages.
I know. I was just chatting with Linda earlier this morning. It's so nice to see Linda here. And
Yeah.
she's coming to the office Friday. Can't wait to see her.
Oh, good to know. We got Eddie Harris from
Atlanta.
Atlanta. Good to have you, Eddie. We got Ileana, who is making herself a regular these days from the Big Apple.
All right, I love it.
Good
Welcome.
Good to have you, Ileana. And we got Alejandro Diaz.
All right.
2 in a row. Allow me to speak my native Espanol.
There you go.
Who else we got here? Brickley Holden is in the house.
Love that.
Good to have you. Our favorite smile from the beautiful Pacific Northwest.
Pamela Myers.
Pamela Myers is here. Pamela, I feel like we haven't said your name in a while. I'm glad to have you back. Justine Herrera, who we say often, and we
My ride-along partner.
Your ride-along partner. Danielle Durant from Portland, Oregon.
All right. New name?
New name.
Welcome.
New name.
Welcome.
Good to have you. I said Danielle like I'm still speaking in Spanish.
Yeah.
Daniel Durant.
You're going to screw up the name sooner or later. So.
For Anglo-Saxon name. It says from Portland, Oregon, or what is left of it. What's going on in Portland, Oregon? Something happened? Jason Santiago.
All right.
Look forward to this episode. Great to see you, Greg and Pablo.
Another longtime friend and client I was chatting with earlier this morning. Jason Lee, thanks for being here.
I love it. I love it. We got the left tackles in the house.
Jeff Moronco.
Who is now from Jacksonville.
That's right. We'll get all the good people.
Again, I realized that Jeff moved here.
That's right.
Dude, my blind side feels totally protected.
Go.
The left tackle. HTTN is in the house. Good to have you, HT. All right, GC. Before we get going, we announced that what is it? 3.99% interest rate, 4.99% interest rate. I'm not a numbers guy.
You know what? You're close enough. 4% is close enough to what it is.
4%.
3.99%. Yeah. Yeah, another reminder to all of you that that 3.99% interest rate is available for all current JWB clients who are adding properties to their portfolio and for new clients who are adding properties to their portfolio. A couple of weeks ago, we announced it. It was a test program at that point. We had 5 slots that were available for those mortgages for those clients. Those have all been gobbled up,
Not surprised.
and we've secured more. So
Okay.
it is still here. I want to make sure that all of you, especially those who are part of the Not Your Average Investor community, that you know about it, that you take advantage of it. I think it's a wonderful thing. So if you are interested and you're somebody who is not a client yet, just reach out to JWB. You can go to chatwithjwb.com. You can send an email to info@JWB companies. You can give us a call. If you're a current client, just reach out to your portfolio manager and we'll get the ball rolling.
3.99% interest rate, heck of a deal in this environment. Not surprised that like limited parts that you opened up got taken.
Mm-hmm.
Not surprised that you got resourceful and opened up some more.
That was the plan.
Yeah, that was the plan from the beginning, right? I like the idea. I think we hit on it last show. The whole idea of like as a vertically integrated provider, your job is to continue to make the buying conditions make sense as as people continue to build for retirement and the scale at which you operate and all the different resources that you have. You guys always figure out a way to make it so that it's not a bad time to buy real property.
Exactly. It's how I get up here for 6 years straight and say this is a good time to buy. It's because whatever's going on in the market, at the end of the day, we were backwards from a healthy IRR, a healthy return on your investment, and positive cash flow. And however we got to get there, we're going to get there. And so that's what you get now, especially as we've secured this 3.99% financing. On every property that you purchase now, you can run it with a 4% rate. It's amazing how much that takes a property that might be struggling to find positive cash flow. All of a sudden, it's right back to those cash flow numbers that you guys have always expected from JWB.
Yeah, part of the benefit of working with JWB out here. I want to welcome Joey and Carol Garvey. They checked in. I think those are new names.
All
as
right,
well. Joey, Carol, good to have you. Make a big friend. So since we have a couple new names, just so you know, the chat is full of community members, a bunch of other real estate investors like you. It's kind of the whole magic of showing up live is that you can ask stuff in the chat. People will give you unfettered opinions. I might not catch it. I might not bring it on the show. But the chat is always lively, and there's like a very healthy community of real estate investors. So don't be shy. I applaud you for checking in the first time that you're here and giving us your names. And I also want to welcome El Gran Amigo is here.
Bill Shields.
Buenas tardes desde Duba. Good to have you, Bill Shields. I know Bill Shields likes to hear me speak in my Hispanic language.
Doesn't.
It doesn't. All right. That being said, headline of the show, Berkshire Hathaway. You may have heard of it.
Yeah.
Warren Buffett's company made a $8.5 billion bet into housing. And what we mean by that is, I'm going to share the article here. They have recently acquired, I'm having a hard time finding the share button. They have recently acquired a company by the name of
Taylor Morrison.
Taylor Morrison. It's Taylor Morrison.
Mm-hmm.
By Taylor Morrison. It is a home builder,
mm-hmm.
right? They acquired a home builder for $8.5 billion, and then they have doubled down. That was a couple of weeks ago. Now they've also doubled down. Berkshire, another one of their companies, Clayton, has another home building group, McGinn Homes, Tumungo, as like the scale rate widens. GC, when you see these kinds of like moves being done by Berkshire Hathaway, what are you thinking?
Well, I back to that as Warren Buffett has Berkshire Hathaway make decisions. They make decisions to invest in value, long-term value. So whenever you are holding the asset that then Warren Buffett comes in and makes a $8.5 billion play in, that should make all of us who own real estate feel really good about the long-term value of buying and holding real estate. To me, that was the first thing that I thought. All right, you know what else I thought of? There's a clip, I think Buffett was on CNBC.
First thing I thought of.
Right, yeah. And it happened, it was probably, in 2020 or 2021. Mm-hmm. And it was Warren Buffett, and they said, hey, what do you think about buying single family homes? And he said, Man, I wish I could just add a few thousand single family homes right now. I think it's a really great investment. So it's now it's not as easy for him when you're at that scale. It's not easy to go and add, single family homes.
Yeah.
But this is following on that vision where he has seen value in housing for quite some time. Right now, he sees a lot of value to be able to buy not just one nationally renowned home builder, but it seems like it's the first of potentially many.
Yeah, looks like he's buying home builders. For me, also went back to that clip. I thought that clip was like from 2011.
Oh, was it?
And it resurfaced again in like the 2020s as well, right?
Yeah.
Like, because I remember we were talking a lot about it when we launched the show.
There you go.
But I see Berkshire Hathaway as a company that invests in fundamentals. And when we talk about the fundamentals here, we continue to talk about this idea that single family homes are a undersupplied critical need for America. Right? Like chronically undersupplied plus critical need, to me, has all the kind of like makings of what Berkshire likes to invest in. I think when it was, like you said, right, in 2011, the scale at which they do it, obviously Wall Street bet big on single family homes in 2020. I think this is another way of him to get, to like, if there's a gold rush, go like sell picks and go sell shovels and picks and stuff like that. He's buying into this thing. And the other thing that I find really, really, really interesting is that at least this new one, it's based in the Southeast as well, right? So he's really betting on this idea that we need to add single family homes to these areas where population is moving, where things are moving. Similar markets that we were talking about that are affected by the jack sport, right? Like where jack sport ships to.
Yeah.
And those kinds of things. I think it's a pretty telling thing that, correct me if I'm wrong, I don't know if he's seeing bottom of like a market, kind of like we talk about the real estate cycle. Maybe he sees like the worst times are behind us, or he's just like, man, this is just a no-brainer of which price I can get into to get into this like undersupplied asset.
Yeah, I mean, if you follow Buffett, he's less about timing the market. He just acts, and usually acts big when he sees value, right? And that's probably what he sees right now. So whether it's the bottom of the market or whether he's a little bit early or a little bit late or whatnot, I don't think he really cares about that. Because as you started to read some of these articles and talk, I have some quotes from the CEO of Taylor Moore, and they asked her, why is this such a good fit? And she talked about how Berkshire Hathaway thinks in terms of cycles. 7-year cycles, 10-year cycles. That's the way Taylor Morrison believes as well. That's, to be a home builder, you have to understand that there are cycles that come with real estate. So when you start to see value, you think long-term mindset, you think real estate, it's all of those same things that we espouse in our model, in our show. It's the reason why we've been able to deliver over $300 million in profits to clients who own single family rental properties. It's because that's what this model signifies. Now, I think the real interesting thing about the timing of this is he's buying a home builder.
Yeah.
And so while he might not be predicting the bottom, or it may be the bottom, I don't think really cares. He certainly thinks the prospects for home builders are strong over the next 3, 5, 10, 15, 20 years.
Yeah.
And I think that lines up with what we've been sharing about what you can expect on the other side of higher interest rates. When interest rates do come down, it's very, very predictable that when interest rates start to come down, those buyers that are sitting on the sidelines come back in. That leads to a rush of demand, a rush of sales, and typically leads to higher home prices, higher than normal home price appreciation in a short period of time as the pendulum swings. So we still are in an environment where interest rates are higher right now, but I think what Buffett and Warren and Berkshire are telling us is, think about the prospects for home buyers on the other side of higher interest rates. What does that mean for the assets that we're holding? It's a good thing. It's a good thing because ultimately means that we're likely to see more demand, more home sales, higher home price appreciation, which is the single greatest way to drive your return on investment. So it's a good thing. It's a very good sign for all of us sitting here who own rental properties.
When I saw that he bought Taylor Morrison, the first thing I thought is like, man, interest rates are high, war is still going on. There's like the oil stuff and commodities. It's a tough time doing it. And I thought, value investing, long-term outlook. When I see him double down and buy another one, I can't help but think of the saying of beware, like be fearful when people are greedy and be greedy when people are fearful, right? Like we're at top fear, and this is his company's buying two companies in the same sector that, like is right now in this really, really scary moment. And like I think you just said it a little while ago, like I wouldn't be surprised if Buffett's buying, if Berkshire, we keep saying Buffett, right? I think Buffett's essentially
Right.
retired, right? Like,
Right.
but if Berkshire is just really like lining up to do a bunch of different acquisitions of home builders who, again, buy the picks and shovel companies before the gold starts, and the gold rush is gonna be homes once this suppressed demand goes away. Like what once the suppressed demand comes to the table to start purchasing again when interest rates come down after being so high for so long.
Yeah, I think it is a very, very strong signal. And I just think that while Buffett knows what's on the other side of interest rates and he understands how real estate cycles work, I also just think he looks at it and says, well, what if interest rates stay higher? Is this still a good bet?
Yeah.
And he looks at that and he's like, well, compared to my other alternatives of what I can invest in, this still makes sense,
True.
right? It still produces a yield,
Yeah.
a cash flow, or a dividend, or whatever you want to call it. All means the same thing,
Yeah.
right? And then it's not, do you think Buffett would be buying home building companies if he thought that the market was going to crash or that there was going to be a wave of foreclosures? No, right? He understands what we talk about on the show, which is this is a consistent asset class. Even after we've had higher interest rates for a lot longer than we all expected, we're still seeing a bottom of maybe flat growth in most markets in the country here. So it's like not just maximizing the up. It starts with value with him, not just maximizing or timing the upside. It's what happens if it just performs the way it is right now. And that's where that max floor conversation comes in.
Yeah.
That's really what I love about real estate. You don't have to time it right. Your max floor is so high here.
Yeah.
And I think that plays. But it's not only Berkshire that's doing this. This is interesting as I was preparing for the show.
Yeah.
Found out that there's not just Berkshire, but Japanese companies are big into buying home builders as well. Would you know that 33 companies, home builders in the US, are owned by Japanese companies? And they're buying more and more and more. So I think there's this undervalued sense of home builders right now, which means that likely good things are coming for the housing market in the not too distant future. And they look at it as a good value play. And I think smaller home builders are probably struggling more right now than they have in the past.
Yeah.
So they're looking at them as good acquisition targets as well. So this consolidation that probably is likely to occur and probably increase in pace in the near future.
Yeah, I like the perspective that you gave of it's not just our home builders are a great buy right now. It's where else are you going to put your money right now that has stronger fundamentals and you feel better about than, like the single family home market in a tough time for the single family home market, right? Like I know that my coach Jerry, he coaches this other guy, home builder in Denver. He's been just like taking it in teeth for the last 3, 4 years, right? Like he's just been in a really tough position because he doesn't have like the multiple spoke kind of like flywheel model like JW had here. And to think that, you're able to maybe pick these companies up at a discount at a time when the market is suppressed. The Japanese deal that recently came through was Sumitomo Forestry closing 4.5 billion deal to purchase Tri-Point Homes, right? That's the big headline from the 33 home builders that they're owning. I think of the Japanese and I think of disciplined people that can do disciplined investment, right? Like, so yeah, it's a super, super interesting time to see all this happening, right? Like when I remember famously, it wasn't that long ago when Berkshire said, we're just going to pull a bunch of money off of Apple and the market and all these different things and sit on cash. Exactly. Right? Like been sitting on cash. And now something has happened where they're not sitting on cash anymore. They're deploying cash and they've now deployed cash into, like at least in 2 instances, into a very specific asset class.
I think there's something to it.
Yeah, I think there's something to it too. So, with that being said, right, like they're not the only ones predicting this stuff. Recently, Fannie Mae has also come out with a prediction of their own on this type of stuff. They're predicting a shift in home sales, real estate market, and they're basically saying their forecast points to gradual improvement in parts of the housing market, even as rates and affordability remain challenging.
Mm-hmm.
Forecast points to improving home sales, home price appreciation, mortgage originations, and broader economic growth. So, to me, this is another data point of there's people with great data, there's people with, like great reach. They're all pointing in kind of like a similar direction of maybe the worst times are behind us in the housing market, which we've all kind of like trudged through for the last year and a half.
Yeah, I think so. The worst times that we're talking about again are like flat growth. We should just preface that. But yeah, the interesting thing about Fannie Mae coming out and this report, and you're starting to see this in other reports, is it's not the first time that somebody or an entity has predicted that things will get gradually better for home sales and home prices and all of those things. But those reports are coming out this year and last year. Those reports were also paired with, we expect interest rates to go down,
Yeah.
and we expect things to get better.
Mm-hmm.
Now you're starting to see reports. This one, I actually looked at the data, and they're still expecting interest rates to be over 6% in their report. So now they're signaling, well, we think things are going to get better, even if rates stay the same.
Yeah.
We don't need this large decrease in their minds and their statisticians and economists to put it together, to put a model together and a projection that says sales are still probably going to go up.
Yeah.
Home price appreciation is still probably going to grow. So I think that's the big shift we're starting to see, that this might be the new normal, and the real estate market can grow, and some are predicting it to grow even if nothing changes from an interest rate perspective.
Makes sense. I mean, you don't have to go far in this article. I just scroll down to these key points of new construction remains limited by labor shortages, inflation, and slow permitting. Real estate investors can expect higher costs and long rates. And it just kicks off this idea of like mortgage rates is on everybody's mind, but it's not the only thing shaping trends, right? Like it's this supply demand dynamic that will, when you're dealing with a critical need that takes so much to bring to market, right? Like you just can't pop it up the same way you can with multifamily and other things. And we've just chronically been behind before. So now we just continue to lag, and it continues to like come. So at some point, even with all the haymakers thrown at it, normalize, right? Like you said, a new normal. Reminds me of the numbers that you were starting to share at the last market update that we can kind of like talk about here, of like what's going on in Jacksonville, can mirrors this stuff, right?
Yeah, so I had been putting, I always review the monthly market numbers here. I don't always bring them up to you guys on the show because we do it once a quarter, and it's a good holistic view. But as I was looking at the numbers, even before we started to prepare for these headlines, I was like, there might be the new normal that we're talking about, when I was just myopically looking at the Jacksonville data. And I thought it was interesting enough to bring it up, put it on our show prep. And I said, hey, I want to show everybody what the month over month data looked like just for June. And I think what you'll see is, as we have pulled some of these headlines out that are just real and I think significant with Berkshire and with Fannie, you're going to start to see some correlations here.
Yeah.
So we're going to go from the macro to the real micro. 1 month, Jacksonville. And because I do think it's noteworthy. So the way to analyze the market is you look year over year. And I just looked June 2025 to June 2026. And here's what you see. So for the median home sales price in Jacksonville, 375. That's noteworthy because that is the single highest median home sales price in Jacksonville history.
Yeah, not surprised.
So
feels like it was in the high 200s not long ago. Like,
yeah, I mean, yeah, it wasn't that long ago, but I mean, it also feels like it was a lifetime ago, because that was, anything longer than a year ago to me seems like a lifetime ago.
Last month feels like a lifetime ago.
So yes, that is the new high of any month. So so I saw that and I'm like, what else do I see? Well, median days on market, 35. It was 37 before. So that means, how long does it take for a house to sell when you put it on open market in Jacksonville, put it on the MLS to sell? On average, it's taking 30, or for a median days, it's taking 35 days. That's low, and going lower. Here's some of the real interesting data, though, why I wanted to show you. Year over year, we've seen 4.9% home price appreciation here in Jacksonville. So from June 2025 to June 2026, about 5% home price appreciation. Been a while since we've talked about 5% home price
In
appreciation,
a while.
right?
Yeah.
Noteworthy there. Now that's just 1 month. What I like to do, and what most professionals who know how to analyze home price appreciation will do, is you don't want to just rely on 1 month of data. That's not a good way to analyze the market. You want to go a little bit farther out just to smooth it over. So we go a 6-month trailing year over year. We take the year over year growth for the last 6 months and average it out. And so you're seeing a number here that's just higher than we've been reporting in previous months as well. So 2.5%, 2.3% is what the 6-month trailing home price appreciation
I
is.
mean, not long ago, that was what, like 0.5%?
Yeah, exactly.
Yeah.
It was just about break even for the longest time. So when you see 2.3%, which is taken the last 6 months on average, and you see the most recent month is 4.9, what that's indicating is that it is likely that you're going to have some home price appreciation for the overall market in Jacksonville in 2026 when the dust settles. Months of inventory, incredibly low.
Correct me if I'm wrong, but didn't the last time that we reported months of inventory wasn't it in the 4s?
Yeah.
And now it's in the 3.7.
Exactly.
So months of inventory is dropping.
Exactly.
Okay.
We are down inventory about 15% year over year.
Okay.
So what Warren
supply is down 15%.
It was a problem a year ago.
Yeah.
Supply was a problem a year ago.
Yeah.
Berkshire Hathaway is looking at supply now much beyond Jacksonville, but if we just use this as a case study, we're looking at it a year ago and saying, well, supply was low. In many markets like Jacksonville, inventory is actually down this year compared to last year by about 15%. And that leads to a low month of inventory, which I know home sales are down from where they were 3 years ago, but if inventory is down and home sales are still relatively kind of where they were a year ago, ultimately that gets you to a lower months of inventory and leads to this home price appreciation.
Yeah.
So when you've got the supply problem and the supply problem is only getting worse, what that does is it creates a high floor for pricing and leads to increased home price appreciation.
Yeah, man. I mean, like when you look at it in a snap, it looks great. When you look at it as kind of like this kind of trend that's happening now, of year over year price appreciation from like January to February to March to April to May, and you see this chart, right? Like for those of you listening on the podcast, January was 0.3%, February was 0, March was 2.8, April was 1.4, May 3.9, now June 2020. This is 4.9, right? So this is like the monthly snapshot. This is not trailing 6 months.
Correct.
This is what makes up the trailing 6 months.
Exactly. Yeah.
So you see so it's not just, so trailing 6 months is at, in the twos, but like what you see is a positive trend over the second half of those 6 months versus the first half of 6 months.
That's exactly right. And just to clarify, we take year over year for each of these points in time. So it takes seasonality out of the equation. You're looking at comparing January 2025 to January 2026, and you had 0.3% home appreciation. You do that for each of those months. So yeah, you're starting to see a trend here.
Yeah.
And I think this is noteworthy. This isn't to say that home price appreciation is going to be gangbusters, but the biggest thing to help all of you who are thinking about investing in rental properties is to help you have confidence that this market has a high floor, right? If you feel confident that this has a high floor, you're much more likely to take action and add to your rental property portfolio right now. And so when I see this, I actually think that this is setting us up for additional home price appreciation more than we probably expected.
Yeah.
Because that's what the trend is indicating. We'll see what happens. I don't care if if it's continues to go up and it's 3% or 4% or 5% or 2%. At the end of the day, it doesn't really matter because we're buy and hold investors. But what I want to do is I want to keep moving people off of this fear, train of thought, right?
Yeah.
Because if you fear, when it comes to something that is consistent, like rental properties, you miss out on time.
Yeah.
And, when you miss out on time, that delays your financial outcomes. And so I think all of the things that we're seeing here hopefully help everybody to move from the place of fear, of interest rates, of foreclosures, of market crash, move us back to normal, because this has been a normal market for quite a long time. And we're starting to see growth happen probably faster than many of us expected.
Yeah. It's hard to deny when you look at, like when you read these tea leaves, right? Like you're seeing headlines coming from what Berkshire is doing, the housing bill being passed, that's also incentivizing housing as well.
Mhm.
You're seeing Fannie Mae predict a recovery. You're seeing the numbers of Jacksonville do their thing. We understand from first principle standpoint that the Southeast is growing. People are also moving here. Like this is a thriving economic area. The headlines that you're getting, and then you layer in this idea that all of this stuff has been suppressed by high interest rates. And there's a moment right now to not just kind of like, I know that we're not trying to predict bottom, right? Like I know that with investing in rental properties, it's just kind of like you get in, it's going to do its thing over time. I'm going to show what real estate cycles actually look like graphically. But it's also hard to ignore this idea of like, man, if I could do this and do it at a 3.99% interest rate right now through
Right.
the program that JWB is putting out and take advantage of this stuff with like the interest rate that you would have wanted anyways,
Mhm.
seemed like a really good opportunity to be buying right now.
Bingo.
Yeah. So if that's what you want, go to chatwithjwb.com and pick a time to get on with the JWB team. A couple of questions here, GC. So
Mhm.
we've had the trends on home price appreciation. We have an anonymous attendee asking, how long does it take to place a renter? How's the trend in rental placements?
It's really strong. Our vacancy is very low. On average, probably, historically it's about 45 or 50 days to be able to go from market to move in.
Mm-hmm.
And so, we build about 2 months of vacancy cost into your pro forma when your property turns, and we're right in line with that, maybe a little bit better. So all
Cool.
things are strong on the rental side.
Gerard Wendling is asking, welcome back, Gerard. Good to have you in here. Not sure what a recently passed housing bill from Congress is all about, but do you think there's a correlation between that and Berkshire buying these builders?
I don't really think so. I think it's more about Berkshire just looking at value and seeing home builders as a value play, a long value play. The reason why is because, the housing bill does some good things, but in order for those good things to be enacted, you still need local government to follow the lead. If the local government doesn't follow the lead and cut some of the red tape, and administer the funds for affordable housing in a way where you can increase density and increase affordability, then this federal housing bill might be much ado about nothing, to be quite honest. So I think there's still a lot to be determined as far as the effectiveness of the bill. It's a good thing. It's moving in the right direction. But at the end of the day, housing, a lot of it is just determined by the local government. So um, I don't think that Buffett or Berkshire Hathaway is going to make an $8.5 billion decision banking on local government
Yeah. Yeah. That
doing
doesn't sound like
everything
them.
as efficiently as they probably
Yeah.
want.
Yeah.
So I just look at that as something that would be nice to have. I think it will help
Mhm.
home builders for sure, if it can be enacted and executed in a way through local governments. But I don't think anybody's banking on it at this moment, partly because it was just enacted and nobody really knows how to operate just yet, given the new standards. It's
Yeah.
it's still so new. So
Yeah.
I think it would be one of those things that would be a nice thing to have and hopefully should help at some point in the future, but probably not something that Berkshire's betting on.
Yeah. They're probably betting on fundamentals.
Yeah, there you
All
go.
right. Good question there, Gerard. Another one from anonymous attendee. Hi, Greg and Pablo. With Berkshire pushing build to rent properties, will this suppress rental pricing increases in Jacksonville?
No, I think so. I think we are starting from a place where we have um, a lot of population and we are undersupplied. And specifically in Jacksonville, we are the sixth fastest growing population and we are way undersupplied as well. So I think there's a very long runway to go. Something else to keep in mind that the build to rent model, because you've had higher interest rates for the last few years, that build to rent model has slowed the production of build to rent.
Mm.
So it's not like there's been an oversupply or overproduction of build to rent. It's been like most things in real estate where the supply has slowed down, the
Yeah.
new production has slowed down because of higher interest rates.
Yeah.
So further exacerbating the supply problem, to be quite honest.
Totally.
Yeah. So
Yeah, there's a trend that I've seen since we've been hosting this show is the idea that kind of like builders react faster than whatever the market is doing, right? So like whether it's if they see a big opportunity, they're like really quick to start building,
Hmm.
but when there's pain happening, they're also really, really quick to slow down. So
Hmm.
they just never kind of like catch up to it because
Do you think Taylor Morrison's excited about having Berkshire backing it
I would
so that
say
it maybe doesn't have to
Taylor,
be so cyclical?
yeah,
Yeah.
I would say Taylor Morris and these other ones are super pumped about it,
Yeah.
right? Like,
Imagine if you could be a home builder and you thought like Berkshire and you had the financial resources like
mhm,
Berkshire. Because while, you know, there's cycles in home building, you give up a lot when you go boom or bust in home
yeah,
builders. You fire all of your staff, your contractors, your everybody, you uproot that whatever team or culture, and then it
yeah,
takes a long time to rebuild the infrastructure to
mhm,
go back and forward. And builders historically just operate that way. Of course, I don't know about the inner workings of Taylor Morrison or Berkshire, but what I know in our own business is by slow and steady
mhm,
we position ourselves to be that much more advantageous for clients and for ourselves as a company when we can weather whatever storm is happening out there, focus, invest in our team, in our culture,
yeah.
and then when things maybe are to your advantage in the cycle, well, then you are 10 years beyond where your competition is. That's what we found through the Great Recession. That was our whole thesis through the Great Recession. And you've seen elements of that over and over and over the last 20 years. So I would imagine that type of mentality would be a wonderful thing for Berkshire to bring to any of their home
Tell me
builders.
more about that, GC. Like, I think that's something we don't talk a lot about. Like, you guys went from kind of starting at the beginning of the Great Recession, right? Losing a bunch, right? Making this like decision to keep the team, invest in the team, grow this culture. Not It wasn't the obvious move for you guys, and now you've made it all the way through till I happen to know this because of our casual conversations, but like you guys, like a year of cash flow in reserve. Like you've made it from this idea of going against the grain to preserve constance, or so what a consistency,
Yeah,
right? Like to preserve
consistency.
consistency to now being in this place where you have continued to value consistency and you continue to be able to raise your own money and do all these different kinds of things. Like for a company like a Taylor Morrison or these ones that are getting this like infusion of capital, like what is the thinking behind like what they're doing, and what does this allow them to do to be able to have the backing like this?
I can't really speak for Taylor Morrison,
Yeah,
but I can just speak in generalities about
yeah,
how home builders typically operate. It's boom or bust, and it's our big bet and what really put us on the map was the critical decision that we made in the teeth of the Great Recession, where we were losing money, and it would have been very easy for us to pack up. It would have been very easy for us to walk away from the debts that we had. We had private lenders that we owed millions of dollars to, that it would have been very easy to walk away from all of that. And many of our friends in the industry, that's what everybody did in 2008 and 9 and 10. And we just never once considered that. We paid every private lender back because we knew that there would be a time 20 years down the road where we would be sitting here and I would want to be able to tell everybody that we always paid our private lenders back, even in the tough times. So we did that. And that meant that we took great losses on individual properties.
yeah,
And that's just what we did. We lived in losses for many years in the beginning of our company. But we made that critical decision. The other critical decisions that we made were to invest in the team.
yeah.
There were 3 or 5 or 7 of us as a company when the Great Recession happened. And I was 23, 24, 25 years old. I had some great ideas and a lot of effort that I was willing to withstand a lot. I didn't care about how hard I was working, but I didn't have a whole lot of track record at that point that this was going to work. So it was a very, very big bet. But we said, you know what? We're going to double down on systems. We're going to double down on our team, grew our team. And we said, you know what? The big bet that we're making is that we understand how real estate cycles work. We think. Again, I was 25.
Yeah. Yeah, like it's wild. Like I'm looking at you and you're like, this was 20 years ago and we made the bet no one going to be in 20 years. I'm like, I know that it's because they're the same age, but like I see you as not an old guy
Yeah.
and you're talking about like a 20-year track record. It's just like it's a little bit I don't know. It's hard to like equate what you're saying with like looking at you and seeing you as a pretty young dude right
Yeah.
now,
I
right?
mean, but that, and
Yeah.
we were so different, and
Yeah.
it made all the difference.
Yeah.
We were called crazy. We would go into real estate rooms and we would bring our team, and we would have new hires with us. And they're like, what are you guys thinking? Run for the hills. That's what every real estate investor told us.
Yeah.
So anyways, that's just what the beginnings of JWB were like. But you know what? You get dealt some cards, and you just have to make us. Sometimes you just have to make a decision, and that was one of the things that we planted our flag in that has made all the difference for JWB. It's led to this, you know, maniacal like commitment to long-term success for our team,
Yeah.
long-term success for our clients, long-term success, overall. And that starts with our team and our culture and investing. And so that's why when COVID happened, nobody lost their job at JWB.
Yeah.
It's because even though the world was on fire, we had planned for a rainy day.
Yeah.
And we looked at it and said, you know what? We don't exactly know what's going to happen, but want to preserve our culture and our team because we had lived through this. And on the other side of whatever externality came our way, there was this amazing opportunity for us to be so much farther ahead than everybody else who bailed.
Yeah.
And so, we have seen that over and over and over again. And, and I would imagine as I think about Berkshire and I think about home builders in general, generally home builders don't think that way.
Yeah.
And it's hard to think that way if you don't have deep pockets. We didn't have deep pockets in the beginning. We were just really young and hungry and scrappy and figured it out.
Yeah.
But, I would imagine that any home builder has the benefit of being acquired by Berkshire or any other companies. Now, not only has that long-term view where you help people see financially why it's to your benefit to maybe lose a little bit of money in the short run, because of the gains you make on the other side and as well as the capital. So I would imagine there's probably going to be more home builders that are super excited to be bought up by Berkshire.
Yeah, that makes sense, man. It's funny. You talk about the Great Recession and you talk about kind of like making through COVID, but like for me, my lived experience watching the real estate industry in this seat is when we first started this show in January of 2020, there was a handful of like big real estate communities, groups, buyers in Jacksonville that were all doing their thing and everybody was thriving. And most of those are not around today.
Right.
Like they made it through COVID, right? Because COVID, they getting got good.
Yeah.
But they haven't made it through the higher than normal interest rate environment, right? Like same thing that happened to my buddy's company in Denver, right? Like they've all had to like completely shift, be different businesses. They're not called the same thing anymore. They're not the same business model, whatever. While you guys are still here, chugging along, stronger than ever, opening up downtown headquarters, like developing $1 billion worth of like real estate out here. It's super interesting to hear you talk about the Great Recession times. And for me, it's like, I don't know why you wouldn't even talk about like these days right now, but I assume that you have built enough of these reserves in this operational thing that you haven't been as scared as you were in those moments. Like those moments were just completely different.
Those were scary back in the day. Whatever challenges are thrown away now with the benefit of experience, reserves, proper planning. I mean, and this commitment to the long term. And we like to invest in boring things, boring business models, right? And when you pair all that together, you have something that lasts 20 plus years as far as GWB. And when I relate it to your decisions to owning rental properties, that's why rental properties work so well to build for your retirement account. It's all those things that we were just talking about in the course of a business or with JWB, at the end of the day, it's investing in an asset that generally goes up in value over a long period of time. It always goes up in value over a long period of time. So,
we have a good representation of that. I remember when we were setting up for this show, we were thinking this is a good time to talk about market cycles.
Yeah.
Right. And like to talk about how people see market cycles. And when we talk about a bottom and like we've had this over the career of the show, we've had this kind of like a couple different times that we've hit on like, wait a minute, a real estate market cycle is probably not the right maybe cycle in the word, because when you think of market cycle, you think of up and down.
Right.
and like circular, right? And the graphic that we show the most is this graphic that shows a cycle in its own right? Like it shows the trend line of how over time Jacksonville has stayed on this like median trend line of um again, not great with numbers, five, like 4.9%.
4.8%.
4.8%, right? Like, even though you see the bubble here with the Great Recession, and then you see it come back down, and then you see it come catch back up, and then you see us above it in during the COVID era, and then kind of like dance right back to the line. This was the normalization period. It was kind of like this return to the line where things had been flat. And even in this, you see all this up and down, right? So I challenge you to come up with a graphic of like, how do we look at actual home price appreciation in a way that shows this? And you came up with this, which is really, really interesting. Did you see? Talk me through this.
Yeah, you know what? I loved our discussion about this because it kind of struck me that when people think of cycles, they think of up, positive, growth, or decline, like you were mentioning.
Yeah.
But in real estate, you don't really see that. You see above average growth or below average growth.
Yeah.
It is very, very unique to see decline. And that's why cycle, even though it is a cycle, it might be a misnomer.
Yeah.
Because in the rest of the investing world, when we talk about cycles, we have periods where we make money and we lose money.
Yeah.
But in real estate, when it comes to home prices, it really doesn't work that way. So this was something that I think will help kind of illustrate this point. This is overall U.S. annual home price appreciation rates going back to that same timeline, 1982. And, when we are looking at home price appreciation levels, it is very, very unique for you to see any type of decline when we're talking about the U.S. overall or your individual market. It just doesn't happen very often. But when we look at it graphically here, you see 39 out of 44 years on record, you've had home price appreciation. Only 5 out of 44 years have you actually seen declines of home prices across the U.S. And so that's 89% of years you're seeing growth. Most assets don't demonstrate that. And that's why, as we relate some of these previous conversations, right? Why does Buffett make a bet like that? Well, he understands that home price cycles are different than other cycles. It's not just about, are you going to have profits or declines? It's, are you going to have higher than normal growth profits, or are you going to have lower than normal growth? Which is something that I wanted to show graphically.
Yeah, I love the graphic, man. Because it really is, instead of the up and down that we see on the other thing, this is, always positive. We've talked about this often. There's this like outlier moment, the Great Recession caused by real estate. We don't go back before 82 because there is no data, right? Like there is no like normalized data for all the stuff.
It's just where John Burns has his sources. That's where they start.
That's where they start.
Yeah, 40 years is good enough for me.
Yeah, and I would assume that if we overlay this over 40 years from 82 to 42, we're probably going to see a very similar pattern without this red thing, and maybe the red thing is really only during the Great Depression of like of the 30s, right?
Probably.
So that's the illustration. It's this idea that a real estate cycle isn't up and down. A real estate cycle is like way up or a little bit up, right? And just kind of like continues to happen, which is why this idea of like long-term investment, set it and forget it. This idea of, me betting my retirement in the highest floor, highest return asset class that I would like to have, right? Like as opposed to the roller coaster of other asset classes feels so good to me because I just if I can just keep stacking chips and betting on like this thing to do what it continues to do, it's going to be year over year a good experience of continuing to rise in home prices. And it can't help but like notice that it's been in this last year, the most recent time where it is at this kind of like lowest upward point, right? Like lowest growth. And every other time that we've seen it at like really low growth, it ends up coming back into like these like other high things, except for when it was structurally like an issue inside the housing market, right? So like, I love this representation of the real estate cycle as kind of like up, slightly up, right? Like, and it looks almost like a like a musical thing, like
Yeah.
it's like going up, but it's never right. Like music never goes like negative sound,
There
right?
you go.
So yeah, it's an interesting graphic representation, and
Well, and keep that up there
yeah,
because right before we were on the show, you were saying, wish you could overlay interest rates on
oh
this,
yeah,
and I think that's a really great point. So
yeah,
I'll do that and we'll show it some other time here. But I think it illustrates a great point. What was going on with interest rates in the 80s?
they were super high.
They were super high.
Yeah,
What did US home prices do in the 80s?
they went up.
They went up.
Yeah,
There have been other periods of time where there's really high interest rates.
yeah,
This is this high floor that we keep talking about.
yeah.
Critical need, right? That creates this high floor when there's a supply and demand balance and there's more demand than supply. That creates this high floor. So it's not all about interest rates. And that's what we've seen for a few years in this negative narrative of, oh, housing is going to crash or it's the worst thing or nobody's buying or whatnot. When you look at the real data, you look at it here, it's still been a very, very high floor, even though we have had higher interest rates for longer. The highest increase in the shortest amount of time and the longest amount that they have stayed
Yeah.
for interest rates in recorded history. And we still have a high floor.
And we stay positive.
There you go.
Yeah.
So
yeah. That's huge. Yeah, I can't wait for you to represent graphically.
Yeah.
Got a couple of questions here, GC. Sharmily from San Diego, new name. Welcome to the show.
Welcome.
Happy to have you. Hope I'm saying, is it Sharmily? Let me know. Asking, how much deferred maintenance do you see in your rental properties?
Well, when you buy a turnkey rental property, it's important that you do not have any deferred maintenance. That should be the value of you buying a turnkey rental property from a reputable company, is that they should take care of it. It should be either new construction or they should have had a standard that you are not going to walk in with deferred maintenance. Deferred maintenance would be something like, well, you know what, the roof's in good shape today, but it's 15 years old and you buy the property, right? If you walk into a property like that, you're going to find massive cash flow swings in the wrong direction. So that's just like general. How much do we see? Well, as you can tell, we don't sell properties where there's deferred maintenance for you. It's either brand new construction or it is a professional renovation. Our average renovation's about $42,000. And that's for a single family home that's on average probably about 1,500 square feet. So
before you turn it over to
them. We do all of that and then we sell it to you as a client. So zero deferred maintenance should be your expectation.
Yeah, it's funny, Sharmily. By the way, I said her name correctly the first time.
Nice.
Yeah, I know. That's not the normal occurrence for people that first show the show. Sharmily, so you're special. I'm doing my own, right? I've got like my duplex, I'm doing my own turn right now, in this house, the house hack. And I keep going back to the standards for JWB for deferred maintenance, right? Like it's like the idea of, and correct me if I'm wrong, right? But like you have a standard of only turning over roofs that are like
10 years of life.
Yeah, 10 years of life or more. HVAC, 10 years of life or more, like the major MEPs, 10 years of life or more. And then the surfaces are all invest in highly durable so that people can beat them up, easy to replace surfaces so that like if they do get up, you can replace it without a big cost, and easy to maintain surface areas as well.
Hard surfaces in the living areas for flooring. Those are the things that you've got to make sure that you invest in a rental property that way, because otherwise those big high tech items are going to take you from a positive experience, a positive investment, a positive experience, and just probably get you so mad and probably not wipe you out, but take you out of the game. You're going to throw your hands up and you won't stay in for a full market cycle. That's why you got to work with a team that can provide that type of investment, no deferred maintenance, and a wonderful experience. So you stay in the game.
Love it. And Pam, our favorite smile from the Pacific Northwest, Pamela Mars is asking, we were talking about this 3.99% interest rate JWB clients have available to them right now, still available, right? Chatwithjwb.com if you want to sign up and get that based on all this information. If you want to get a path of progress like Berkshire Hathaway is doing and get into single family homes right now, not suffer from the high interest rate thing and have higher cash flows with 25% down, take advantage of that 3.99% interest rate only for JWB. Pamela Mars is asking, is that rate with Patriot funding?
It's not with Patriot Funding. It's with a new lender that we were able to source. Patriot is a wonderful partner. It's just not specifically with Patriot Lending. However, if you are already working with John and the Patriot team, you can continue to work with them. You're able, even if you can't take advantage of this incentive, specifically this 3.9 rate, we're making it equal for you in terms of other incentives that you get with JWB properties. So no matter how you need to buy, if it's with Patriot, if it's with a special DSCR loan, if you're buying a property in your retirement account, you need a non-recourse loan. At the end of the day, you're taken care of either way. You might not get the 3.99% rate because that lender might not offer it. You'll receive an equal incentive package, so you're taken care of.
We had 75 people here for the majority of the show, right? So like I think it's a really, really important message to see this, right? I think we're all looking for signs of the housing market kicking back up again. We've been talking a long time about how these higher interest rates for longer have been kind of like keeping this coil really, really tight. And once interest rates start to drop, it's gonna spring. But I think we've really underestimated this idea that like even if it continues to happen, even if we get it, it's more likely to go into a new normal than the idea that like there's some like big, like thing that's going to happen.
Right. It may just be that. Yeah. And that is great. Normal is great for us. And so it may be this big swing because the world may shake out in a way where interest rates actually do come down in a short period of time. But we got to get away from waiting for that to happen in order to take action, in order to grow your portfolio, in order to make an investment, because it very well may not. People have been waiting for that for 2 or 3 years, and they've lost 2 or 3 years towards advancing their goal.
True.
So I think we're seeing a lot of signs that this new normal may be here, and just moving away from this fear point, this fear that the market is not going to produce for you. That's the biggest thing. Rather than timing when the growth is going to happen, just away from that fear. Just normal is all you need to produce a great financial outcome for yourself in rental properties.
So good time to buy.
Great time to buy.
Time to buy. Right. I want to thank, first of all, Jen Filson is having a meetup in, she just put it in here, in Cupertino, Sunday, August 23rd. Contact her for more details. Her phone number is 408-833-9868. Jen Filson, the fairy godmother of the Not Your Average Investor Show community. So fully support her getting people together again over in her corner of the world. Jen, thank you for doing that. I want to thank the community for showing up here. Again, 75 plus people joining here for an hour a day, middle of your work day, get educated on real estate. We never take it for granted. We will continue to bring the headlines and the data and the perspective. Next week, we're doing a familiar concept. We have found a couple of live deal sheets out there. These are in the Memphis market. And, deal sheets are kind of like a promise. They're only as good as what you're actually promising, right?
The way you say
and it's pretty easy to fudge a deal sheet in a way that makes numbers look more attractive than they are. Too many people out there are too comfortable over-promising and under-delivering. So we're going to break down a couple of the Memphis deal sheets, see what we see in them, compare them to apples to what you can do with Jacksonville these days. I know that you have a special place in your heart for that type of show, GC.
I love it. And of course, we're going to keep all names and faces and companies out of the mix. We're just going to focus on the data and just informing you so you can make a great decision when you buy your turnkey rental properties.
There you go. So we hope to see you all next week. And from now till then, any of SGC?
Don't be